When do nonprofits pay unrelated business income tax? Imagine running a nonprofit and suddenly facing a tax bill you didn't expect. That's what happens when certain income triggers what's called the unrelated business income tax. Let's break down when nonprofits have to pay this tax and what it really means. Nonprofits pay the unrelated business income tax when they make money from activities that are like a business but aren't directly related to their main mission. For example, if a charity runs a store selling merchandise or a cafe that's open to the public, those are considered trade or business activities. If these activities happen regularly and generate income, they could be taxable. The key point is how often and how the activity is conducted. If a nonprofit hosts a one-time event like a bake sale, it's unlikely to trigger the tax. But if they run a year-round thrift store or a rental business, that's different. The activity must be carried out with enough consistency and frequency to be considered regular. Another important factor is whether the activity is substantially related to the nonprofit's purpose. If the activity helps further the organization's mission, like a museum selling tickets to fund exhibits, it's usually not taxable. But if the activity is mainly for profit, like a nonprofit selling advertising space or renting out property for commercial use, then the income is considered unrelated and taxable. There's also a dollar threshold to watch out for. If a nonprofit earns $1,000 or more in gross unrelated business income during the year, it must file IRS Form 99010-T. This form reports the income and calculates the tax owed. The tax rate is generally the same as the corporate tax rate, which is currently 21% federally. Some states add their own taxes on unrelated business income, so it's important to check local rules. Certain types of income are excluded from this tax. For example, dividends, interest, royalties, rents from real estate, income from volunteer work, and sales of donated goods are not subject to unrelated business income tax. Also, income from government contracts or research activities that are directly related to the nonprofit's mission often don't count. To give a quick example, if a youth organization runs a miniature golf course that's open to the public, the income from that activity is considered unrelated business income and could be taxed. Similarly, if an educational nonprofit sells mailing lists to vendors, that income might be taxable unless it falls under an exception. For nonprofits, understanding when they owe this tax is essential. Not reporting or paying it can threaten their tax-exempt status and lead to penalties. So, it's wise to plan for these activities, keep good records, and consult with a tax professional if needed. In short, if a nonprofit engages in regular commercial activities that aren't directly tied to its main purpose, it's likely to owe unrelated business income tax on that income. Staying aware of these rules helps nonprofits stay compliant and continue their good work without unexpected surprises.